gonna go ahead and start. Okay, I'm gonna just introduce myself. My name is Marco Dalabona. I'm part of the Strategic Alliance team at Agent Co. And I've been in the company for a little bit over a year. I'm from Brazil, but I've been in the US for 26 years. So yeah, I'm just gonna talk a little bit about Agent Co. just so you know a little bit more about the company. Agent Co. has been in the market for over 30 years. We were founded in the 90s. And the goal of Agent Co. was always to take care of the international investor. So the company grew that way. It was founded by two Cuban-American gentlemen. And their passion was to help people that were coming into the States and investing their money. So nowadays we have 56 physical offices in over 30 countries. We have several divisions that serve our customers, through our tax and accounting divisions, audit and assurance. We have a technology division, so Agent Co. became the #1 SAP Business One provider, actually maybe in the world.
Especially in Brazil.
Especially Central and Latin America. We have a global expansion division and a human capital division that supports that division. So nowadays, Agent Co. became really a global expansion company. Always with the focus in tax and accounting. The global expansion divisions, we do a lot of incorporations and entity management. So for folks that come here and buy real estate, which is probably the #1 type of investment for foreigners. So we help them incorporating not only in all 50 states, but also we do more complicated structures, offshore structures, and we also can establish trusts in over 70 jurisdictions. So the great thing about Agent Co. is we're a large company, but we still, serve our clients as a boutique company. We can serve not only the individual that comes by one house, also wealthy families and large corporations with subsidiaries in several countries. So our goal here is to talk about some topics on tax that and accounting that has to do with foreign investment. Obviously, we also serve the domestic clients. So a lot of the individuals that move to the US, a lot of them have, they go through an immigration process and they become domestic clients. But we do bring a lot of value for individuals that have components in multiple countries. So, you're a tax preparer. So, one of our specialties is foreign compliance. So a lot of folks, they have a lot of businesses back home or have to integrate multiple jurisdictions. That's part of our expertise. So I'll let Camila introduce herself.
Thank you. So Mark and I, we are the same team. I've been here for almost 5 years now. So we are part of this Strategic Alliances team that basically is a fancy name for people who construct relationships with attorneys, realtors, family offices, those main pools of clients that are our kind of clients, right? So as he said, we've been founded over 30 years ago, and fun fact, at first our main focus and only focus at the time was real estate investments in the US for foreigners. So that's still a huge part of our approach. That's still our day-to-day discussions that we have in our meetings. Only today we do also much more than this. So as Marco said, we can assist investors in real estate in the US in several areas. You probably are familiar how people can come in, just be happy with their purchase and not necessarily think through the tax impacts, whatever they're gonna have to worry later on when they gladly do a sale, right? So there's also the concerns that come with it, the FIRPTA that may apply, we'll go over it, state tax, every kind of investment structure, and we can assist them with before doing the sale in the future, before purchasing the real estate, probably making a way that it's more efficient for them in the future.
I like this slide because this kind of touch up on some of the concepts that you guys deal with, every day with, FIRPTA compliance and not only educating the client about FIRPTA, but also what happens when they are going through a sale and now they need a file to get their refund. FERPTA refund. So we help clients with that. Estate tax and gift tax planning. So I have a case today of a gentleman that's in the Netherlands, and the father sold the house but gifted the money to the son who's in the Netherlands, and he needed to know, okay, so what do I do with this gift? It's $1 million gift in the US, how it's going to impact him here in the US, but also how it's going to impact him in the Netherlands as a tax resident. So we do a lot of that type of integration as well. You know,
do you handle all different countries in the world, or like you mentioned Netherlands, and you guys are from South America? Do you do a lot in Asia too, or where are your offices?
well, good question.
I
So on the entity level, we do have the ability to do the accounting and the tax compliance through our global expansion division. A lot of times we integrate with their local providers, but also our network allows us to provide service, you know, in their countries of origin. In Asia, I think we have an office in Singapore and in Hong Kong. But a lot of times we have the ability to integrate with their own providers. So in this case of the Netherlands, through our office in the Netherlands, I'm able to provide, it's a local office that provides service to our office there. So it becomes a very seamless, and the tax managers can talk. So they can help classify, you know, how is this income classified here? How is it classified there in the Netherlands? So it kind of works out.
Yeah, and also we are at a moment now exactly of global expansion. So I'm from Brazil, I live there, and we have been in the past 2 years acquiring many offices around there are now becoming H&Co and starting to provide services there, for instance. So the same happens in other countries. We are at this point that maybe when you come ask us 5 years from now, can you help us, I don't know, in Australia, we will have people there. We will have our offices, H&Co offices with H&Co employees there. So we are exactly doing this at this exact moment. So we are already very strong in the US. We are actually very strong in Brazil because, as Marco said at the beginning, we have this SAP division in there that's been there forever. But we are now also becoming strong in other countries. That's our goal for the next 2 to 5 years.
Just let me just finish up these 2 points. Income tax management and rental properties, and that it's just, you know, the accounting and tax support for people that have short-term rentals here or long-term rentals. You know, like you guys are the ones to provide the dream of them. You know, these people buying their first home. You know, outside of in the U.S. But with that comes with a lot of accounting and tax responsibilities. So we help, educating the clients and educating the realtors, how to, not only structure, but how to provide opportunities for the client to have the best fiscal benefit, or, just have a type of service that he would have back home as well.
We basically handle the boring part.
Yeah, but we want them to make sure that they feel at home, So a lot of times, we feel comfortable in our own country with our own language. So Agent Co now, we're a very diverse, company. So we have people from pretty much, all over from all over the world. So we try to make the client feel like, okay, it's a second home away from home. And then investment structuring, we have a lot of developers that come, like for example, Brazilians. I see that very often. They come and they develop. They buy land and they build homes and they sell homes.
Warehouses.
Or they're flipping homes, and a lot of them create investment funds, and where they have a pool of people investing money, and then with that they invest specifically in real estate. So we help them with that, with the complexity of managing those types of investment structure.
Yes.
So to break it down, very simple, we have a foreign buyer.
Yep.
What kind of problem are they going to have with the U.S. government?
Okay.
Call
We are here for you, not to have a problem.
Not necessarily, but I think the most important, and I think she's going to go through, I'm not going to spoil understanding what triggers taxation. How is there, one is, income. So what types of income they need to understand. Obviously, it sounds obvious to us, what types of income when it comes to real estate, capital gains, your rental income. But they need to know, first of all, what triggers taxation? When do they have to report? Like, for example, I had a gentleman that actually owns a unit here. He doesn't rent the house. Yeah, he doesn't rent the house. It's just for his own use. So it doesn't trigger taxation. Yeah, it's a second home. So he doesn't, so he came to the office. He's restructuring more for succession, right? Just for asset protection, succession and all that. But he doesn't need to file taxes. So all that is our...
Until he decides maybe to sell.
Exactly.
Correct.
But I'm going to tell you, my favorite kind of clients are the one that you just described that comes beforehand. I'm going to buy a property. What do? I love them. The ones, but also...
already sold and go, now what do
Yeah.
I do?
Can you please plan my structuring for the sale that just happened? No, I can assist you with moving forward, but I mean...
But anyways, I'm gonna try to answer your question briefly because she's gonna go through it. I think the main answer is we educate them possibly before they make the sale. And one thing that we have a lot of, we're very careful is to make sure that we don't complicate. So the real estate agent, it doesn't affect their sale.
Yeah.
Because that can be a lot of information in the beginning. State tax, FERTA, do this way. Do I open an LLC? Do I not open an LLC? What's the amount of the house? Who's going to be, is it a partnership? Who's going to be in this partnership? What if I want to leave it for my kids? And then there's all these hypothetical questions that, part of what we do is trying to simplify in a way that it makes the realtor look like a rock star. We can be like a back office, but also facilitates the sale and makes it easy to do business in the United States. Yeah. That's the most important thing. Especially they come from a country that's very bureaucratic. To open a company it takes 3 months, and if you have to dissolve a company it takes 8 months.
That's what I tell my clients. I mean, you're from Brazil, you're gonna find it so easy to do business here, so don't worry.
Yeah. So anyways, hopefully part of the presentation will answer this question, and then at the end of the presentation we can talk about it. But it's a great question. Yes. Yes. And then there's some peculiarities, which is short term, long term. Some people come buy homes and then it becomes a long term. How does that affect on their tax returns? Short term, if they have other activities, you can commingle the loss, and you can, obviously you can prepare your tax in a certain way, but it's a long term is different. What defines short term rental? What's the frequency to be able to be qualified as short term. So we can get really granular on all these concepts. But today I'm going to let Camila go through all the concepts, and I'm sure we have enough to talk about. And before actually we continue, I wanted to thank Anastasia and the people from Zenodro for inviting us. And thank you guys for taking time of your day, to come and share your time with us. Yeah.
And also, just so you know, Marco and I, we are not necessarily CPAs, but we do have, because the office is a CPA firm. So we are CPAs specialized in international clients. And when I say we as a firm, because Marco and I are supported by all of this huge team of CPAs in our backup. So whenever you have questions, even today after the presentation, or if you want to have a meeting with one of them, we are happy to coordinate. We are happy to connect you guys. Okay, so...
have you heard the term, we know enough to be dangerous? That's us. We know enough to be dangerous. But we know our place. Obviously, we try not to give advice, obviously. But
basic advice we do give, because people in general don't know much. But
ask your CPA.
Depending on, because more often than not, I lead the Brazilian market, and my experience with Brazilians, and I'm Brazilian myself, so I can say, is that they want more than a free first consulting may be able to give them. So they want numbers, simulations, and that is something we need more time other than 30 minutes in a first meeting to provide. But we are happy to give all knowledge that I came to realize recently. Many firms charge for, basic questions like which state should I incorporate my LLC, or should I have an LLC or a corp? So these basic generic questions, we are more than happy to assist from the beginning without charging for it. Okay, so basically the four main, not only, but the four main taxes that may apply for your clients, right? And here we are specifically saying about the foreign clients, so Brazilians, Europeans, Asians coming to the US to invest in real estate. And I'm sure you're more familiar than them with all of them. One is the estate tax. So as you may know, the property is subject to 40% on its fair market value at the date of passing of the owners. And that's one of the reasons why we usually suggest them to structure the ownership in a way that is not directly held by the person. One of these ways is with a foreign corporate blocker, but that triggers another kind of problems. We will get there soon. And also foreign corporations, because a corporation doesn't die, are exempt. Then we have FIRPTA. I'm curious, how many of you are familiar with FIRPTA? Okay, so we are in the same page. Okay, so there's this withholding. That's the client that I was telling you guys that when they come, I have had this property for 10 years, I'm selling it now. I've heard they will have, more often than not, they didn't hear anything. They figure in the day and they are scared to death. They will have this withholding of 15%. What can I do? And that's more often than not too late to do something. But we are always happy to structure beforehand to avoid it, because it's unpleasant to have 15% withheld by the IRS on the date of sale and then need to file a tax return later on to have it back. So that upsets my clients very often. And then we have the capital gain, so the long-term taxes that apply, which are, in this case, for that specifically, owning the property in your personal name may be more interesting than through a corp, because you have the maximum rate of 20%, while a domestic corporation or even a foreign corporation will have to pay the flat rate of 21. So that's a good thing, because 20 is the maximum, right? You can still have much less than this. And then the income tax, which will apply in your rental income, if any, just follows the tax bracket as an income tax individual in the US from 10 to 30%. And that's for individuals, because companies will be subject to the same flat rate of 21%, just as the capital gain. So that's a generic background on the taxes.
Do you want us, if you want us to go back, and then if you have any comments, Kathy?
Okay.
Go ahead.
Just had a question. The foreign individuals, when they have the income tax, that would be on the typically capital gain if we were talking about something that had sold.
The income, the one? Okay.
Or I guess if you had rental income each year
Yeah.
or whatever. The U.S. is a worldwide taxation of income country, but in these cases, because they're clearly foreign, they are not subject to worldwide income having
Correct.
to be reported on the U.S. tax return.
Unless they exceed their substantial presence test.
Okay.
Yeah.
Okay.
If they do that, so let's say if they own a house, right, they're getting income and they're coming, let's say they'll rent in that, which is not usually the case, because a lot of times they rent for long periods of time, like short term, but they don't spend a lot of time here. But they can technically, if they came, let's say, and stayed here for 7 months and then rented the house and repetitively did that, and they surpassed the 183-day substantial presence test, they become tax residents.
Yeah.
Then you can amend 1 year, but then the following, if it goes 2 years, then it becomes a little bit more challenging. Then it involves, but
Amount is also a factor. The income amount
of
how much they're taxed.
Oh, there's a slide showing it. Let me.
yeah.
Okay, so here's considering a foreigner, right? So even if they are married, they will be considered single for U.S. tax purposes. And that's 2025. We may have more updated for 2026, but just to have an idea. In order to get to the maximum rate of 37%, here's the amount that would be taxable. So it takes a while, especially when it comes to, for instance, rental income. There are so many deductible expenses that we put in the accounting, so at least in the paper, it doesn't show as profitable. So it's actually very hard for our clients to have to pay taxes on their day-to-day activity, and especially having to pay the highest amount. I'm sure we have cases like this, but I personally didn't have any in this past few years. But very good question about being a US or not person to how they're going to be treated on their worldwide income. And Marco also gave a really good answer, because there are those 3 ways for a foreigner to be considered a US tax resident per se for income taxes, right? So they were either born in the US, even though they live abroad since they were a baby. They can have obtained a green card, or, which they don't know, they've spent way too much time in the US and they went ahead to this substantial presence test that basically takes, let's say, in 2025, half of the portion of the time they spend in the US will be considered into the calculation, and in 2024, you have to divide it by 6. So then you sum with 2026, and if it reaches 183 days, then you are considered a US tax resident, unfortunately for them, that are always catching a surprise. But we usually advise clients to keep an Excel organizing, if they come too often, to keep an Excel,
Usually,
be aware.
it can become very technical, but this is part of having a partner or someone, a CPA. You can advise the person, so you can kind of take them by the hand, and then you can explain certain concepts like that. I have a case where there's a Dutch guy, and he doesn't own anything here, but he met an American woman, and he's been dating, and he's been staying over
Too long.
the 183 days. So now he's considered a tax resident, and he's done that multiple years. So now he's come to us, say, hey, do I need to file? Do I need to file? Then you have to file a form to declare close connection to his country. So then, those are technicalities. But I think for us, is here is more the focus on the real estate, because it matters to you guys.
And I apologize. This is in Portuguese. I had a presentation yesterday. I got it from another presentation to show you guys. But basically, the most often deductible expenses like condo expenses, insurance, commission paid for the realtors, they can include the flight ticket, the flight cost they had. At least we are conservative. We tell them we can include 1 per year if they are going to the state of the property and they are happening to be there. Not like, my property is in Florida, I'm going to New York, can I put it in the expenses? No. How am I going to justify it?
But if they come to Florida first,
Yeah.
and then they
Yes.
separate the portion like
Correct.
that,
Exactly.
and they go stay at a hotel, it's fine too.
Yeah.
Yeah.
If they're here to make
It's got to be connected to their
Yeah.
business. Yeah.
Exactly. Depreciation, if they are going to have advertising, so they can include it as well. All general costs that we try to put as much as we possibly can in a way that is safe. If the IRS has an audit, we can confidently explain why this is related to the property. Okay, so here's the tax brackets we're saying, and for individuals, the 20% is in a little bit less, right, than in the income tax amount. But
If the numbers are not accurate, it's just mostly the concept.
for 2025 they are, just not for 2026. But we're now delivering the 2025 tax return, so we're fine. Okay. And then, what do we usually have as the most common structure to avoid it, right? So we are going over a few of them. There are infinitive possibilities, but here are the most common ones. First one, we have the individual ownership or disregarded entity. It seems to have a difference between them two. There is, but not as much as one may expect. So let's say I'm a Brazilian. I'm gonna purchase my property in the U.S., I'm gonna hold it through my individual name. So that happens a lot with my older clients, couples that have been having their property for 30, 20 years. So what happens to them is that they are subject to the rental income tax of up to 37%. And the capital gain is the maximum rate, as we said, of 20%, which is good because they don't have to pay 1% more. But it's still, I mean, when you're a foreigner and you have to pay taxes in dollars, 1% can be significant. And also it's a cost-efficient structure, right? Because you don't have to incorporate multiple companies, have annual maintenance costs of those legal entities and everything. If you do incorporate an LLC, though, in the middle between you and the property, sad news is if this LLC is 100% held by the foreigner, that doesn't give you limited liability in Florida. Some other states might be different, but in Florida, that LLC will not grant you the limited liability you were expecting with it. And also, what people usually don't know is that this LLC, 100% held by a foreigner, is considered a disregarded entity for U.S. tax purposes. What it means is that even if you had no activity, it most likely, 90% of the times, needs to file an information return annually. It doesn't mean it's gonna have to pay taxes, but it does mean that it has to file an annual return. If you go by the IRS law, what it says is it doesn't have to if it didn't have any related transactions. Related transactions are, for instance, the amount, the $45, $50, $100 the individual will pay on an annual basis for the state of Florida to keep this company active in Sunbase. So that triggers already the obligation to file an annual return as a disregarded entity. So they will have the cost of incorporating, maintaining, and filing this annual return without the liability, right? And failure to file exposes them to a penalty of $25,000. So that's often not really very beneficial.
And this is real. Why? Because
And
every year we incorporate thousands of companies, right, for clients. And right before the deadline, right, for
March 15 first.
March 15, we have to find out who these people are and make sure that they're either filing with us or they're filing with someone. Why? Because we've seen this penalty be assessed to people that $25,000. And then so we got to make sure that they're covered. They know they need to file. Why? Because the liability is on us. You know, if we were the ones who incorporated the company. So this is something that a lot of people say.
Annual Florida informational return is what we're talking about.
Not necessarily, not the Florida one, that's the federal to IRS.
Oh, the federal.
Yeah, it's Form 5472.
Yeah, it's the 5472 pro forma.
It wasn't a thing until...
Also, Florida requires you,
Yes.
if you have an LLC.
If you have it as a C Corp, not as a disregarded entity. Yeah.
Tax return for Florida, yeah, no.
So the disregarded entity is basically just it's an informative return for an LLC that's owned by a foreign, that's owned by 25% of the LLC is owned by a foreigner. Okay. But it's real, you know. So, and I know that because in my first year in the company, like they were like, Marco, all these incorporations that you took care of, were these people, are they filing or not? Because it
doesn't have to be with us. We just want you to file with someone.
Yes, yeah, we just gotta make sure. No, we gotta make sure because we did the incorporation, so it's a liability on the client if they are not aware of it.
There's a point, the clients get annoyed because we start to harass them, you have to file.
Right. It doesn't have to be with us, but you have to file. Anyways, these are things that affect, you know, foreigners that open LLCs here. You know,
so. Held 100% by them, right? We'll go over other structures. So also, in either those options, if there's a sale or rental income, the guy here or the lady will have to file an individual tax return as well, which they don't adore very often. And still they are exposed to estate tax and FIRB tax. You wanted to ask something?
Yeah, just to be clear, if it was, this is only required for if you're 25% foreign ownership, or I thought basically everybody who has an LLC has to
Yeah,
file?
yes, that's what it says on the form.
Okay.
Yeah.
But in this case, it's more likely that's a sole proprietorship. So
Okay.
so he's owned, the company's owned 100% by a
Yeah.
a foreigner.
Yeah.
And
We
I
don't
know
really.
They went back and forth a lot.
Yeah.
That informational return, you did have to file, no, you don't have to file, yes,
Yeah,
you do have to file.
we are too conservative to say no, you don't have, because as I said, what RS says is if you didn't have any related transactions, you're fine, you can go. But what does it mean if you don't have any related transactions? It means that something is wrong, because if you didn't pay your annual renewal in Florida, which is already a related transactions, you are out of compliance in Florida, not tax-wise, but with the annual renewal in Sunbase. So there are accountants that will say, oh no, that doesn't consider, we don't consider this related transactions. But I mean, we would rather have the client spending $950, $1,000, $1,500 per year with this information return rather than being somehow exposed to the 25 penalties. So
It's a big thing.
what is cheaper? So we go very straight by the law, and we consider any related transactions are related transactions. So that's why we advise clients to file it. And that's one of the options, right? So let's go to the next one, in which is the client becomes aware of all of this I just explained, and they say, okay, what if I include my wife then? We will both own the LLC. So one part, it's great, but because now you do have limited liability. You are no longer the sole owner. It's a two members LLC. So now you have the limited liability you were seeking for. And you still have only one level of income tax, which means that only the individuals will pay taxes in case of rental or sale to the brackets that we already saw. However, there are other problems with this. At the same time that it's good to have only the individuals paying taxes, it's bad that they do have to file tax returns. And in this case, we are talking about 3 different returns. 1065, which is the information for the information return for the LLC as a partnership. The LLC is not the one paying taxes, but still it has to file the Form 1065. In case there's rental or sale, right? If not, then you're good. And then we have individuals here having to file Form 1040-NR. So we are talking about 3 different tax returns, which may be costly on an annual basis. Okay, so that's the second point here in the disadvantage. And then they are still exposed to state tax, and although it does somehow avoid FIRPTA, that can be very tricky, because people will say, oh, that way I can avoid FIRPTA. That's right, you're not subject to the 15% withholding on the sale. However, as a partnership, the partnership has to withhold 30% related to each partner on a quarterly basis until it files a tax return in the following year. So you sell one thing and you become exposed to another thing. So that's also not the most common structure, not the most loved, by the clients. What is then?
Now I do have a question. Has any of you ever had a client come back and say, "Hey, just sold the house. Now what do I do?" With FIRPTA, and you've never, because I'm curious, because we see a lot, and then having to, you have to explain, if they're in a partnership and all that.
I once lost a client because he was yelling at the realtor at the meeting, and I was like, you should have informed yourself. Like, they're not CPAs, so.
Yep. Yeah.
Okay. What is then the most common structure for foreigners investing in the US? Okay, so what you usually advise, it depends on the case, but more often than not, they will have a US, it can be an LLC, it doesn't have to be a corporation, but it has to be treated as a corporation for the IRS. So you can have an LLC, so the legal entity name will be blah, 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 LLC, but you do file this specific form with the IRS to have it treated as a corporation for US tax purposes. That US LLC/corporation will hold the property. And who's going to be the owner of the corporation? Another corporation, which is a foreign corporation. And then you have the UBOs at the end of the structure owning the corporation, the foreign corporation only, not the US one. That avoids state tax, that avoids FIRPTA, because FIRPTA only applies for foreigners, right? And in this structure, you have a US corporation and a foreign corporation, so you are kind of double protected.
Having two corporations in the middle. Oh, okay.
Yeah.
That makes sense.
Why the foreign corporation is useful here? One, because of the state tax, and two, because even, let's say, because foreign corporations, they are way more expensive than a domestic one. So let's say the client says, oh no, I don't want a foreign corporation. That's all right. But if in the future you sell your portion of the US corporation, guess what? FIRPTA, because the US corporation... The IRS did think this through.
FIRPTA is like the boogeyman. Everybody tries to one.
Our CPA is industry worse than mine. Okay, so another good thing about it is that only the corporation has to file tax returns, so there are not multiple tax returns being filed. And here's the answer to your question that you asked about the Florida state tax return. In this case, we have two returns being filed to the corporation, the federal one, 1120, and the Florida one, 1120F. But we do them, I mean, the clients don't even know we're filing two returns. It's basically two in one. But it's only for the corporation, the foreign corporation, then the individual, the IRS don't care about them as long as the US LLC is treated as a corporation. And also, good thing, you have the limited liability. No one cares about the individuals. Clients adore this option. Especially Brazilian clients. I don't know why. They've done nothing wrong, and they are scared to death to be seen by the IRS.
And that goes back to your question. What do I say to the client that comes here and goes like, well, what if the IRS? What do I have to do to avoid the government? And I think now to answer the question is not as much the government, but in a case of a sale for FIRPTA, for example, if you're an investor, you want to make sure you have your money in your hand for the next investment. And if you're, a person that now is at a certain age and you're thinking about your kids and you're converting your own currency to dollars because it's a form of an investment, and you want to leave your assets to your kids, now estate tax becomes an issue, right? If you're 65 and so. It's not a one size fits all, but it depends on the client. And so now what happens, your risk now is very big. Why? If something happens to you, now the family has to deal with the state tax, which is 40%. So that's not...
But not here.
That's huge.
Not here. I'm just saying her initial question is like, what do I say to a client? You're a foreigner, you own a company in Brazil, you bought a property here, now you have, let's say you have the tax obligation, right? Now you're immigrating. Now you become a tax resident, and you don't declare your foreign interests because now you're taxed on your worldwide income. Then it becomes an issue. An issue that is like now it's real. You can be audited. They can come after you with penalties. That doesn't mean they're going to knock on the door. The IRS will never do that, but they can assess penalties. And then we have a lot of cases of streamlined procedures of folks that now have immigrated, forgot to file, forms, and now they're having to pay taxes on the years that they didn't file. So that's more like the
goal is to sell the property, and if you do have a foreign buyer, they are going to ask these questions.
yes.
And if they ask these questions and you don't know, they're going to be like, oh, well,
And I've seen that there is, for the realtor stuff. Why? Because you don't want to increase the cost on the client. You want to show a house is $200,000, especially if they come into a place like this and they go like, "Whoa, there's a swimming pool.
I mean, but
it's
comparing to the
beautiful,
property,
it's
it's
modern,
nothing, so.
and it's $500,000." Anything beyond that, it makes them think, "Oh, now I gotta pay now taxes. I gotta pay this." I know we understand that. So at first we try to just have them understand, there is risk, and then try to educate them, thinking about the future. Then a lot of times they start thinking, okay, I want to buy this one, but I want to buy another one to rent, But at the end of the day, it's better to live with less risk, you know. And
It's a very personal choice, though.
yeah.
But anyways, so in this structure, what is, as Marco said, one of the disadvantages, it is costly to maintain. And then forget about the maximum rate of 20% on capital gains. It's not as separate as in the other options, like what is rental income, what is capital gain. It's a flat fee of 21% either on rental profit or on the sale. And also, and here's what clients hate to realize, besides the 21% that you are already paying if you have profit, you also, on any distribution that you do from the U.S. corporation to the foreign one, to the individual, to whoever, it may be considered dividends, and it's going to be subject to plus 30%. And also in this structure, there is the Florida state tax of 5.5%. There's an exemption for the first 50,000, but other than this, it's subject to this amount. So there's
The first 50,000 in income is exempt?
in Florida, correct.
Okay.
But let's say you have a profit of 70,000, then you have to pay for, on the 20, correct. And clients, and I mean, even me personally, I hate to tell them about this 30%, and they go, okay, so how do I avoid it? Is there a way legally to avoid it? And yes, there is. Here's what we usually suggest in those cases. You keep your property. That's not gonna be your entity for whatever other business you wanna have. You are gonna be safer if you have another LLC for other business, for other properties, for investments. Why? Because once you sell this property, you are able to file a final year tax return of your LLC/corporation as such. And after the LLC has filed its last tax return, it's gonna just be dissolved in the state of Florida. And then you can get the money without triggering dividends, correct? And then you're safe. So in order for this to work, you have two options. You can either have a lot of properties under the same LLC or corporation and sell all of them at the same time, or you have one LLC per property, correct, in order to avoid it. You can use the same for a corporation, which can be a BVI, a Bahamas.
The best way is one for one.
One LLC per property.
Per
Yes, unless you're very confident you're going to sell everything at the same time.
Yeah.
But in this case, it's even, that solves, if you do sell everything at the same time, tax-wise, you're fine. But then there's the limited liability that can flow one from another. That's not very interesting. So we advise you have one LLC per property. That's costly, but that's safest. And that's pretty much the most chosen option when we go over to clients through all these options. And we usually, when they engage with a CPA, they can even have, simulations and for their specific cases, for their property amount, for their specific characteristics, any other possibilities of structure. 90% of the time they're okay with this one. That's the one they choose. So
With just one member.
you say here,
Uh-huh.
doesn't matter.
Okay.
That doesn't matter.
Yeah, I think, and I guess we can just do maybe we can just do a Q&A now. We can more talk about it because it's 12:30. I want to make sure that you guys have other, appointments. But the partnership LLCs is very common. I see it all the time. It became almost like here, it became standard. A lot of times people come to us. They already have an LLC. Why? Because
when they already have something. That's right.
For known residents. No, I think it became a standard in the industry, and for a lot of them, opening a bank account with an EIN becomes easier. Or an IT number. So a lot of the banks, they require certain. It's easier to open a bank account. So they've developed. Go ahead, Bianca, sorry.
So one of the reasons why it becomes standard is to qualify for the mortgage. So a lot of the times when they're getting a property like this, mortgage brokers tell them to open an LLC to get the loan.
Correct.
Yes.
So you're not buying it cash.
Yeah.
Most of them probably put like 40 to 50%.
Yeah.
So yes, thank you. And Reason why, because it became standard. A lot of them, even the buyer already, they've done some research or they've talked to, and they already know, oh, I'm buying a house, I need to open an LLC. And a lot of times it helps in a way, right? Because you have an LLC, and a lot of them open as a partnership. And I think the partnership was an attempt to avoid FERPTA, number one, but also you dilute the state tax. So if you're buying a $400,000 home, you know, it's a husband and wife, it's $200 each one of them. You know, you're looking at the threshold of $60,000. Your liability is $120,000, $140,000 per person in that investment. I'm just thinking objectively. I'm not saying that that's what it's recommended, but it's something that we see very common. And the point that I want to make is there's a lot more to it. And that's why we've been very successful helping realtors, is to be able to educate. You have the background, to educate your clients, being working with tax, and Kathy, you're being a CPA, but it's important to cover these topics so there's no surprises, and we can make it very easy to understand. I imagine, as a realtor, you have to show the property, you have to talk about all the costs, and then you have to, go around and then talk about taxes. You're like, and so.
But quickly going back to our question, here they can put, they can either be like, let's say the father of the family, he's going to be the sole owner. However, there will be something written, if they want, in the documents of this foreign corporation, that is the right of survivorship clause. How do you say clause?
Clause.
Yeah, clause. It says that once he passes, the others will automatically have the portions of this foreign corporation. In paper, that doesn't mathematically make much sense, because it says that all of them are 100% the owners. But that's perfectly legal, and that works to avoid the will in BVI, let's say, in the US, and that doesn't work in Brazil, though. Brazilian government doesn't consider this as reasonable, but that's then a Brazilian problem overseas.
They have one. They do have one. Yeah, here, yeah.
So, yes. Do you have any questions?
I have a client in California that and I don't know exactly the titling of the property, but it's a mom who was elderly, and all the kids are not U.S. citizens. So they're some in Asia, some in Canada, and so they talked about selling it last year. And then they backed off when they said, well, if we wait till she passes, we get the step up in basis. So there'll be less income, possibly zero, which is a smart thing. So they waited. She is now since passed. I haven't gone back to them, to talk to them about, well, do they want to sell? At this point, whatever the titling is what it is, and then there would be possible estate issues.
Right, the probate.
But probably not much income tax, because the step up in basis. So do you have that type of situation?
Yep.
Be able, maybe be able to advise them whatever they might or might not need to do related to estate taxes?
Oh, yeah.
We have one of these every 2 weeks.
Yeah. We can definitely, something that we do a lot. We do a lot of courtesy calls. We're like handyman's. We can assess costs or scope of service until we see. We have to know the case. Yeah.
But they're being smart, because one of the things that happen very often is that the clients come, they say, that's a different case scenario, but it happens every week. A client comes and they say, okay, so I own this property on my personal name. I'm gonna sell it. I already have the buyer. And I was thinking, I have this property. I want to put it in a structure to protect it for my future buyers, to my future kids, everything. Can I put my directly owned property under a structure? yes, you can. However, what the IRS is going to say is that you are doing a sale, even though you are transferring to your own structure. So you have to file something called notice of non-recognition to avoid it, and that doesn't apply for every case. So everything you do, you have to be very cautious, very, step by step, guided in order to make it happen in a way that is tax efficient for you, because your clients are indeed being very smart because they have thought of something, but more often they come with the solution in their minds that doesn't necessarily is going to work. So we are happy to advise in any other cases.
Great, thank you.
Thank you, guys.
Okay, we can share this later on if you want, and then you have our contacts here. I was super happy to be here with you guys today, so thank you for your time.
Thank you.
If you like, we can send this slide through, because we got your cards. We can, if it's okay with you, we can send an email to your and I'll copy Camila so you have both of our contacts.
Thank you.